Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader on SMB's Options Trading Desk. So today I would like to talk about risk aversion and capital sizing a little bit. I had an interesting discussion this week with a terrific trader on our trading desk, one of the leaders of our Options Tribe trading contest, Jen. And Jen has been on our trading desk since the spring of 2015, earlier this year, and she's been doing great. And it is our practice to increase the capital level of traders who are doing very, very well with us, and we try to do that on a consistent basis to reward them for the success and to encourage them to make even more money and be even more successful. And so this time I had a little conversation with Jen, and I asked her, how do you feel about this capital level? This is now getting to a pretty substantial amount of capital. Are you comfortable with us raising you to this level of capital? And she answered me two ways, which I thought was very interesting. The first one was, any raise is welcome to me, which I thought was very funny. And the second point, though, I thought was very telling and really forms the basis of this talk today. And that is, she said, what you need to understand is that P&L to me is just a number. I think of things in percentages. And that was such an intelligent point on Jen's part. And I want to expand on that so that folks can understand what she meant and why that is such an important principle. So let me give you a little bit of background. The kind of trading we do on SMB's Options Trading Desk is called options income trading. And this is a game where you're going to win most months. These are typically monthly trades. So you have 12 measurement periods a year, so to speak, but you're going to lose occasionally, once or twice or three times a year. And so if you look at any one month, it's not meaningful. You have to look at the entire year in totality. It's an annual return game. People who do this for a living typically make between 2.5% and 5% a month weighted average. So that includes the wins and the losses, et cetera. And if you look at all of that and kind of weight it over a year, typically you're going to see returns in that range. And in the midst of any given trade, to be down 10% of your capital is not at all unusual. It could be seen as fairly common. Even on a winning trade, you can be down 10% at one point and end up 10% by the completion of the trade. In fact, when the market sells off very hard, many times the trades will temporarily have a terrible looking P&L. And that's primarily because of temporary options volatility spikes, which usually work their way out of the system eventually. So what is the meaning of all of this in the context of Jen's comment about percentages versus dollars? Options traders, I've noticed over the years, who focus on the absolute dollars that they make on their trades, those people, as they increase their capital levels, they tend to get overly excited and close winning trades too early, and they absolutely freak out when a losing trade is occurring, and they tend to change their trading style to protect the trade, overly protect the trade as dollar amounts get larger. Still, if people are taking gains faster and losses a little bit faster, you can be actually moderately successful trading that way, but you're never going to get above moderately successful. But the people who can accept larger levels of capital, ignore the absolute dollars involved, and just look at the percentage returns, those are the people who can be spectacularly successful as options traders. Just think about it. If you're trading a $10,000 account and you're down 10%, you're down $1,000. If you're trading $1 million account, which is very common at a prop firm, and we have traders on our trading desk trading at that level, then you'd be down $100,000. And we've had traders down at certain points in trades down $100,000. So unless you are used to being down $100,000, most human beings are going to freak out at that level, particularly when the typical level that they're normally expecting to be drawn down on a trade would be closer to $1,000 or $2,000. So how do you work with the fact that you want to take a successful trader, give them greater amounts of capital without absolutely freaking them out with the amounts of dollars involved? So how do you handle this issue of traders becoming more risk averse as capital levels increase? I see traders breaking into two categories in this regard. One are people like Jen or John Locke, who's also on her desk, two people who seem to be somehow impervious to dollar amounts. They can just focus on the percentages. The rest of us mortals, though, are affected by the dollar levels. It's natural. And if you can't get the dollar levels out of your mind, then what I recommend is, as you're increasing your capital level, very carefully journal and note how you are trading. And if you are seeing any changes in the way you're trading related to the dollar levels involved, and you will know when you get there quickly, because you'll be freaking out if you are at a certain loss level, or you'll be overly exuberant at a large dollar amount, but really not that big of a percentage increase. If you get to that level, you're trading too large. It means it's affecting your trading. You will not be successful after that point, because you're changing the math of options income trading if you start fooling around with the way you're trading and becoming overly protective. So therefore, what I recommend is, once you detect that within yourself, and that's usually when you take a loss that you really shouldn't have taken because you were freaking out about the dollar levels involved, and you just closed the trade before you allowed it to be successful. If that kind of thing happens to you, what I recommend is to go back down to the previous capital level at which you were trading and feeling completely comfortable and trading completely normal. Stay at that level for a while. Build up your confidence at that level for a 3 to 6 month period, and try it again at that next level. You're going to get rattled at too high of a capital level, and you're not going to trade well. Trust me, I tell you this from experience. Capital sizing is a big deal. More traders blow themselves up over the issue of sizing up too quickly because they've been too successful, basically, and they haven't had a loss that was really a bell ringer, so to speak. More traders will blow themselves up over this issue than any other. So it's a very big deal. The way I look at risk tolerance is, it's a muscle. It's a muscle that you must build over time for most people. Most people need that. The way to build that muscle up over time is through gradual increases in capital. Over time, you will become a successful trader if you do everything gradually, particularly from a capital standpoint. If you get, I'm going to say this again, if you get to a level where you see that you're trading differently, that's a warning sign that you're about to turn unsuccessful. Go back to the previous level where you were feeling successful. Build up your confidence and give it a shot at another time. That's really important advice about capital sizing, and I think it will help you to be a more successful options trader. Thanks very much, and we'll see you next week.